At its core, short selling is the act of selling something that you don't currently own in the hopes of buying it back at a lower price in the future. Welcome to this video about short selling in trading. If you're new to investing in trading, the idea of selling something you don't own might sound a bit counterintuitive, but stick with me and we'll explore the concept of short selling and why it can be an important tool for traders. What is short selling? At its core, short selling is the act of selling something that you don't currently own in the hopes of buying it back at a lower price in the future. When we talk about short selling in the context of trading, we're usually talking about short selling stocks. To short a stock, you'll need to borrow shares of that stock from someone else and then sell those borrowed shares on the market. The hope is that the price of that stock will fall, allowing you to buy back those shares at a lower price and return them to the original owner, pocketing the difference as profit. In the case of a trader taking a short position, they typically borrow shares from a broker without specific knowledge of the share's origin or ownership. The borrowed shares could come from another trader's margin account, the broker's own inventory, or even a different brokerage altogether. It's worth emphasizing that in these transactions, it is the broker who acts as the lender, rather than the individual investor placing the trade. Short selling has a long history in the world of trading. It's been used by traders and investors for centuries to make money in both bull and bear markets. Short selling has been a controversial topic in the financial world, with some people seeing it as a necessary part of the market, while others view it as a dangerous practice that can contribute to market volatility. Why do people short sell? There are many reasons why someone might decide to short sell a stock. One common reason is that they believe that the stock is overvalued and that its price is likely to fall in the near future. By short selling the stock, they can profit from that downward trend. Short selling can also be used as a hedge against other positions in a trader's portfolio. For example, if a trader owns a lot of stocks in a particular industry, they might short sell a stock in that same industry to protect against a market downturn. Another reason why people short sell is to take advantage of market inefficiencies. In some cases, a stock might be mispriced due to rumors or speculation. Short sellers can take advantage of these mispricings by shorting the stock and waiting for the price to correct itself. Risks of short selling. While short selling can be a profitable strategy, it's important to understand the risks involved. When you short a stock, you're essentially betting against it. If the stock price goes up instead of down, you could end up losing a lot of money. Additionally, when you borrow shares to short a stock, you'll usually have to pay interest on those borrowed shares, which can eat into your profits. Short selling can also be risky because there's no limit to how high a stock's price can go, meaning that your potential losses are unlimited. Short selling can also be risky because of the potential for a short squeeze. A short squeeze occurs when a large number of traders have shorted a stock and the stock price starts to rise instead of fall. As the price rises, these traders will need to buy back the shares they borrowed to cover their short positions. This can create a buying frenzy that drives the stock price even higher, causing even more short sellers to cover their positions and pushing the price up even further. Short selling in practice. Let's walk through an example of short selling in practice. Imagine that you believe that company X is overvalued and that its stock price is going to fall in the coming weeks. You borrow 100 shares of company X from a broker and sell those shares on the market for $50 each, costing you $5,000. A few weeks later, company X's stock price has fallen to $40 per share, and you decide to buy back those 100 shares for $4,000. You then return those shares to the broker you borrowed them from, and you've now made a profit of $1,000. Short selling regulations. It's important to note that short selling is a highly regulated activity, and different countries and markets may have different rules and regulations regarding short selling. For example, some markets may limit the ability to short sell during times of market volatility or require short sellers to disclose their positions publicly. Additionally, short selling is sometimes banned altogether in certain markets, as was the case during the financial crisis of 2008. Short selling myths and misconceptions. There are many myths and misconceptions about short selling, which can lead to confusion and misinformation about the strategy. One common myth is that short sellers are bad or evil because they are betting against a company's success. However, short selling is a legitimate trading strategy that can provide liquidity and price discovery in markets. Another misconception is that short selling is always a one-way bet, meaning that you'll always make money if the stock price falls. In reality, short selling can be a risky strategy with the potential for large losses. Short selling and market efficiency. Short selling can also play an important role in market efficiency. By allowing traders to bet against a stock's success, short selling can help keep stock prices in check and prevent bubbles from forming. Short sellers can also uncover information and expose fraud in companies, leading to increased transparency and better market outcomes. Examples of short selling in history. Short selling has played a role in some of the most significant market events in history. For example, during the 2008 financial crisis, short sellers were heavily involved in exposing fraud and mismanagement in the subprime mortgage market, helping to trigger a market correction. Short selling has also been a key strategy in the rise of activist investors who use short selling to push for changes in company management and operations. In conclusion, short selling is a complex and often misunderstood trading strategy that can provide opportunities for profit and help keep markets efficient. However, it's important to understand the risks involved and to follow regulations and best practices when engaging in short selling. By understanding the basics of short selling and its role in the market, traders can make informed decisions and take advantage of opportunities in a rapidly changing financial landscape. Thanks for watching, and don't forget to like and subscribe for more essential trading tips.